The short-term Treasury opportunity. Right now, 3-month Treasury bills are paying 5.5% with virtually no risk. Never before have short-term Treasuries looked so attractive, offering the highest yield on cash equivalents since 2007. The inverted yield curve makes this possible. You're getting paid more to take less risk than with longer-term bonds. It's a rare opportunity, but you need to understand both the benefits and the risks before diving in. Think of it like finding cash in your couch cushions. Unexpected, but you'll want to use it wisely. A $100,000 investment in 3-month bills generates $5,500 in annual interest with minimal risk of losing principal. Compare that to a 10-year Treasury note yielding 4.5%, which comes with much higher price volatility. The shorter duration also means you can reinvest at higher rates if they continue rising. However, this strategy can backfire if rates fall faster than expected. JPMorgan's fixed income team highlights this exact risk. While short-term Treasuries are appealing now, reinvesting at lower rates becomes a problem if the Fed cuts aggressively. Their advice: build a ladder of maturities instead of going all in on the shortest bills. This means buying bills that mature in 1, 3, 6, and 12 months, spreading out reinvestment risk and maintaining flexibility. The current yield curve supports this approach. 1-month bills yield 5.4%, while 1-year bills pay 5.2%. That's a smaller drop compared to the 1.5% gap between 3-month and 10-year yields. By laddering maturities, you capture most of the short-term yield advantage while hedging against rate changes. If rates rise, you can roll into higher-yielding bills. If they fall, you've locked in some higher rates for longer. Money market funds offer another way to access these yields without buying individual bills. Funds like Vanguard Treasury Money Market, the USXX, currently yield 5.3% after expenses. They provide daily liquidity and automatic reinvestment, making them ideal for parking cash. The trade-off? Yields adjust immediately when rates change, unlike individual bills that lock in rates until maturity. The Fed's policy outlook adds uncertainty. Markets currently expect 2 rate cuts this year, but inflation data could shift that. If inflation remains stubborn, short-term yields might stay high longer. On the other hand, a weakening economy could prompt faster rate cuts, causing yields to drop. Laddering helps hedge both scenarios by ensuring you always have some cash maturing to reinvest. Corporate treasurers are already ahead of the curve. JPMorgan reports that 78% of corporate cash now sits in maturities under 1 year, up from 55% in 2021. Retail investors can take a cue from this strategy, especially given the tax advantages. Treasury bills are exempt from state and local taxes, making them particularly attractive in high-tax states. For someone in California's top bracket, a 5.5% Treasury yield is equivalent to about 6.5% taxable. The opportunity cost of waiting is significant. Keeping cash in a near-zero yielding account costs you roughly 0.45% per month on $100,000, adding up to $5,400 annually. Even allocating half your cash to short-term Treasuries can make a meaningful difference. Liquidity isn't a concern. Treasury bills trade in the world's most liquid market, with minimal price impact and bid-ask spreads as low as 0.01%. This makes them ideal for emergency funds or short-term savings goals. Inflation remains the biggest risk. While 5.5% beats current inflation, real returns could turn negative if price growth accelerates. A mix of short-term Treasuries and inflation-protected securities, TIPS, can provide both yield and inflation protection. To simplify management, many brokerages offer auto-roll features for Treasury bills, automatically reinvesting maturing bills. This hands-off approach ensures you maintain your ladder, though you'll lock in whatever the current yield is at each roll date. For most investors, 6-month bills may hit the sweet spot. They yield about 5.4%, just 0.1% less than 3-month bills, while offering more time before reinvestment risk kicks in. Splitting your allocation between 3-month and 6-month bills balances yield with flexibility.